what are completion accounts and how do earnouts work? In this video, we will be discussing purchase price adjustments in mergers and acquisitions. Make sure to stay until the end of the video to find out what to include in your SPA to avoid legal disputes. If you're new, I'm Malcolm Zoppi, an English qualified solicitor, and I help UK SMEs with their corporate and commercial legal needs. Also, I do M&As. Great, let's jump straight into it. There are two main types of adjustments to the purchase price that we will be discussing in this video. Number one is the completion accounts, and number two, earnout provisions. Let's take completion accounts first. Completion accounts are the financial accounts of the target business as of the date of completion. Typically, what they aim to do is establish a value of the target business as of the time of completion. Why are these relevant? Well, the buyer and the seller will have negotiated a purchase price, and we might have specified in the SPA the purchase price alongside the target assets and target liabilities of the business. Now, the completion accounts are going to look at the actual assets and actual liabilities, compare them to the target assets and target liabilities, and for example, if the actual assets are more than the target assets, then the purchase price is increased, whilst the opposite is also true. On the other hand, if the actual liabilities are greater than the target liabilities, then the purchase price is decreased, and the opposite again is also true. Typically, these price adjustments are made by increasing or decreasing the deferred consideration that is outstanding from the buyer to the seller after completion. Great, so let's move on to earnout. With an earnout, the buyer and the seller will negotiate two main numbers. Number one, the purchase price, and number two, the target profit that is to be generated over a number of years. Let's call that period of time the earnout period. If during the earnout period there is more profit than the target profit, then typically that excess profit is to be given to the sellers, and therefore it adjusts the purchase price by increasing the deferred payment. The opposite is also true. If during the earnout period the actual profit is below the target profit, then that adjusts the purchase price by decreasing the deferred payments. These purchase price adjustments can either be done pound per pound or whatever other metric that the parties decide to agree on. Now, before we discuss what to include in your SPA to avoid legal disputes, feel free to send me an email if looking for professional legal advice. Great, so what should you include in your SPA if looking to avoid or minimize the chances of legal issues? First, when it comes to completion accounts, you'll want to include a schedule in the SPA that details exactly who is to prepare the completion accounts and how these completion accounts are to be prepared. Instead, when it comes to the earnout situation, you may want to include in your SPA provisions that tell the sellers who are also managing the business during the earnout period what they are and are not allowed to do. The reason to do so is because sellers during that period are more likely to prioritize squeezing out as much profit as possible instead of longer term gains. The reason being is that they're not going to be there to benefit from those longer term gains. And instead, if they squeeze out as much profit as possible now, they increase or adjust the sale price in their favor. Whether you are the buyer or the seller, and whether you're doing completion accounts or earnout provisions, having a close working relationship with your M&A lawyer is extremely important. And if you want to learn how to enable your M&A lawyer to look after you as much as possible, make sure to watch this next video to learn how to prepare for a call with your M&A lawyer. Thank you for watching.